Why does a yield curve inversion actually matter? All we see in the media right now is yield curve inversion this, yield curve inversion that, but what does it actually mean for the plumbing of the financial system? And the 2-year is currently way up at almost 3.13%. This is an incredible.
This is the takeaway from it, is that it costs more money to borrow money for the short term than the long term. And when you think about this doesn't make any sense, because if you're a lender and you're going to lend out money, the longer that the money is lent out, the more risk that you, the lender, have to take on. And so presumably the higher interest rate you'll charge, or at least compare it to, let's say, a 10-year versus a 5-year, a 10-year versus a 2-year, or whatever, right? So let's make a real world example of this. You've got a friend, and the friend wants to borrow money from you. And you say, okay, listen, I'll be happy to loan you money. But here's the deal. If you only want to borrow money for, let's say, 6 months or whatever, right? I'm going to charge you 5%. But if you don't want to pay 5%, I'll tell you what, you keep my money even longer or whatever, right? And instead of charging you 5%, let's say keep it for 10 years or whatever, right? I'll only charge you 1% or whatever, right? And this doesn't really, again, make sense on the surface, because if anything, it should be the opposite. If you, the lender, are loaning your buddy the money or whatever, right? The more that you have your money tied up with your buddy, the more risk you have. What about inflation or whatever else might come your way? And so you would demand a premium.
I mean, if you're lending to your buddy for 10 years, you don't even know if you're going to be friends in 10 years, let alone if you're still going to pay back the money. So why in the world would the market be pricing short-term loans above long-term? That means they think it is safer to loan at a lesser rate 10 years into the future than it is in just a few years. And not just the 2/10 inverted. I mean, the entire yield curve is just flopping over its side right now. And that is horrible for financial stability and counterparty risk into the future. What incentive would a bank have to make a loan in this kind of environment where they could just buy a 2-year treasury, secure their yield, instead of just having actual risks to lend for less money at longer duration?
Another question, this is something that Manarino raises, which I think is a very darn good question to ask, is the more demand you have for a bond, or the more buy pressure there is, the lower the yield. In other words, the more people are willing to pay for the bond, but the amount the bond pays stays the same. So that essentially the implied interest rate goes down. So when you see a central stepping in and trying to manage the yield curve, that suggests that the central is going in and basically providing artificial demand, or I guess selling, but really buying, I suppose, is the way they would accomplish it. Whatever bond strata they want to target, that's what they start buying. So for example, the Federal Reserve is trying to manage a 10-year treasury and they want to get it down. They're going through and they're buying the 10 years. And the reason they buy it is because this puts pressure, this makes what they pay for the bond go up. And so therefore the implied interest rate of the bond goes down. Likewise, one could say, if they want let's say the 10-year to go up, the rate to go up, what they could do is they could either sell 10 years, or probably more accurately, they would just simply stop their buying and let the current 10 years they have expire off the balance sheet. But the big takeaway is, but mechanics aside, the question still remains that why is the bond market, who is generally regarded as the smart money, what is spooking the bond market, supposedly the smartest guys in the room, to prefer longer-term debt over shorter-term debt, particularly from the U.S. government? Because theoretically, a treasury, whether it's a 1-year, 2-year, 10-year, 30-year, whatever, right? It's the U.S. government that's standing behind it. These should all be fungible, save for the duration of the bond itself. But in any event, something is spooking, the bond market to drive this discount. Don't know what it is, but it signals that there's a problem.
Well, definitely. The short end is much more oriented on what the Fed does. Right now, the market's pricing in that they're going to continue to raise rates. And that is a big portion of why the short end is going up so much. But the fact that the long end is not only not going up, but actually coming down in that circumstance signifies that the market is not convinced that the Fed will be able to continue this over the long term. And they're going to actually have to reverse course and cut rates. And we can see that if you're looking at Fed funds probability calculators, just what the actual market is suggesting Fed funds will be, and they're starting to price in rate cuts going further out into the future, because the Fed's obviously, or the market's pricing that the Fed's going to break something, which means they're going to have to slash rates back down to zero. But it still remains that at the moment, if you're a bank, what incentive do you have to loan? Because if I was a bank right now, I would much rather own a 1-year treasury or 2-year treasury, which is actually yielding me a decent percent, instead of going out and making a loan at 3% when I can get 3.5% just for a 1 year, instead of taking that risk of actually not knowing if you're going to get paid back. And if banks lending, we're not going to see any growth in the economy. because that's kind of what's funding these small businesses, which means we're going to go further down into a recession.
And that's just from the perspective of being an American. Here's where it gets really interesting is, let's say you're a foreigner or whatever, right? Well, the same argument applies, but now you've got like two things going in your favor. Number one, for those who are in crypto land, essentially the yield on the dollar is going up, whatever, right? If the dollar is going to strengthen, number one, I want to be in the dollar versus being in my own currency. And the icing on the cake here is that if the Fed continues to raise interest rates, I might be earning, 1 or 2% over there versus like, 0.25% of, let's say you're in, Japan or whatever, right? And you get the currency edge from the dollar appreciating against your native currency.
So this is the yield curve inversion for dummies. What else do you want explained? Thank you.